So welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. We're going to be mixing technicals with fundamentals once again today. And in front of your screens, you have your USDs for chart. Now let me add some toolbars here, starting with standard, adding also for charts, line studies, and time frames. We're talking about the 4-hour time frame. And practically every chart is to be of the same time frame unless otherwise stated. And at this point, I would be also, you know what? I'm going to take out some indicators about volume. So give me a second. You can find it in the objects list. Give me a sec. Working on it. Okay, here we are. Now we have in front of our screens, as we have noted, Euro USDs for our chart. Let's zoom out a little bit. And we note how the price action was able from yesterday to rise, break the 1.0747 and actually break also the 1.0837. That was wow. However, that could be changed into 1.075. And I'm going to be expanding, or if you prefer widening, the resistance support lines here. I'm going to be doing a recalibration. Zooming out. Okay, let's make a start. Definitely the S1 here remains. Could go a little bit lower though. Somewhere here. That would be the 1.0635. The RS, the R1 has to be turned into a support line. And we're noting as the first resistance line the 1.0885. Yep. Okay, we have the support levels ready, and we have the first resistance level ready as well. Let's zoom out a little bit. Unlocking the chart, moving a bit lower, just to catch this peak here. And that would be the 1.01040 in red. And the next one, a little bit higher, quite higher. I would be setting this peak here as the margin. That would be the 1.0265. That's it. Let's also add some labels and make everything more visible. Yep. Okay. Let's start with Euro USD. Now, as we're going through the changes in the chart, allow me to have a small chat about fundamentals. Now, we had the release of the US CPI rates yesterday for October. That was a bit of a shocker for the markets, as practically the CPI rates slowed down beyond the market expectations. And that forced actually the US dollar to weaken substantially across the board. So that was one element which I would say that tended to solidify the market's expectations that the Fed most probably will be abandoning any plans about a possible rate hike in the future, and most probably will be remaining on hold. It's characteristic once again that the market now expects the Fed to remain on hold up until May and proceed then with a rate cut instead of any rate hike during that period. At this point, I would also like to note that, okay, we still see the case for Fed policymakers, some Fed policymakers, to continue to lean on the hawkish side. But the balance of power within the bank, I think, will start tilting more towards on hold. So the internal struggle within the Fed is shifting. And I think that would be the main characteristic. Adding also the label for the R1 first resistance line, now being set at the 1.0885. Mind you that the level was tested actually in the past 24 hours and was able to hold its ground. So that tended to intensify the validity of the level as a resistance line. And moving to the first support line, that would be a prior resistance line, the 1.0750. Yep, in green. That's better. Setting now the S2 at 1.0635. And the S3 at 1.0495. On the other hand, regarding the euro side of the pair, I would be noting German 7 indicators yesterday, actually, before proceeding with any fundamentals about the euro. You know what? I'm going to be lowering the S3. It's not satisfying. Actually, this show here, we cannot miss that. That's better. And that would bring practically the S3 at 1.0450. Could go a little bit higher. Let's check it out. Yep. Okay, let's zoom a little bit into the chart. That's better. Now we can see exactly the validity of the levels, as practically the S2 used to be a resistance line, while the S3 proved its worth as support line here. The S1 also used to be a resistance line. The R1 was tested yesterday, actually during today's Asian session as well. So that's pretty valid. Let's talk direction. Now, regarding direction, I would be noting here that, okay, we can see how the pair has hit the ceiling at the R1, 1.0885. However, the bullish sentiment remains despite the RSI indicator lowering a little bit. It's still above the reading of 70, which may imply that the bullish sentiment is still rather strong for the pair. I would be noting, though, that it may be also signaling that the pair is still at overbought levels, and a correction lower is still in the cards for the pair. On the other hand, though, we have to note that despite the price action of Euro USD actually breaking the upper Bollinger Band, has now stabilized, and there is some distance between the Bollinger Band and the price action as such, which could be allowing some room for the bulls to play here. For the time being, we tend to maintain a bullish outlook, yet I wouldn't be surprised to see a correction lower. Once again, though, should the bulls maintain control over the pair, I would expect it to breach the R1 1.0885 and start aiming for the R2 1.1040. Especially should the weakening of the USD be maintained, Euro USD's upside potential increases. And I'm mentioning this because we have two financial releases which are key regarding the US dollar today in the American session. The first would be the release of the US PPI rates, and they're also for October, like yesterday's CPI rates. Now, the PPI rates are measuring inflationary pressures at the producers level. Now, should the PPI rates slow down as they are expected to, that would highlight exactly that prices are easing their ascent higher at the producers level as well, and that may more or less be rolled over to a consumer level and slow down the CPI rate. So practically the PPI rate also measures, partially at least, the quality of the CPI rate. And should there be a slowdown, that would be a bearish signal, in my opinion, for the US dollar. Thus, bullish for Euro USD. The second release, which I would be highlighting today from the US, would be the US retail sales growth rate. It's for October. It's expected not only to slow down, but to fall and actually contract to reach minus 0.3% month on month. Should that be the case, that would imply practically a weakening demand side in the US economy, which may allow for inflationary pressures to ease further. So both of these releases tend to point towards further weakening of the USD, at least the expectations for those releases. Should the actual rates and figures meet the respective forecasts or be even lower, then we may see the USD weakening and Euro USD's bullish tendencies actually being realized. On the other hand, we have to note here that the R1 has acted as a ceiling to Euro USD's ascent. And for the time being, I would be noting here that more or less we may see that stabilization being maintained, given that the RSI indicator has dropped a bit, but nevertheless we would require a wider drop, which could come only in the form of a correction lower for the price action. Now, the possibility of a downward motion, in our opinion, is very remote. However, such a scenario should be covered, but for a bearish outlook, we would require the pair to drop below the S1 1.0750 and start aiming for the S2 1.0635. I know it's a little bit difficult, that's why I'm not mentioning the bearish scenario as quite plausible right here now. Well, let's have a look now at USD-JPY. Actually, before USD-JPY, let's have a look at GBP-USD. And that was an interesting movement. Once again, we had a rise of GBP USD. Note how the level has broken the 1.2305 as well as the 1.2465. So both of these have to be turned give me a sec. Yep, 65 into support lines. Okay, at this point, I'm going to be highlighting this peak here. And the second peak I'm going to be highlighting is this one. It's pretty narrow though. Could go a little bit higher, but for the time being, I'm keeping these two peaks, and the fourth will be here. All in red. Now, cable moved in an upward motion, and that was understandable given that practically could lower it to 40. Give me a sec, please. Given that the USD side of the pair weakened. On the other hand, though, okay, definitely the R2 is a little bit too wide. Let's have a look. We can find something else. That's a nice peak. Can see how there was a nice sideways motion here. I'm keeping this as a resistance line. 1.2815. We're adjusting, placing some labels, starting with the instrument. The R3 now being placed at 1.2995. Let's make it a little bit smaller. And in red. Now about cable. We highlight the big rise of the substantial rise of cable, which was practically forced by the release of the lower than expected US CPI rates. We had a twist though for cable, and the twist was that also the UK CPI rates for October came in far lower than expected, which was a surprise for the market and actually tended to weaken the pound at the time of the release. But overall, the market reaction was far, far narrower than on the release of the US CPI rates. And that more or less reopens the possibility of a bullish outlook in the American session today, given that the US financial data due out, we have mentioned that the PPI rates and the retail sales for October may weaken the US dollar. Should that be the case, we may see practically cable being able to jump higher. And that's a big question whether that's going to be happening. Definitely the resilience shown by the pound to the lower CPI rates, which were released today, was indicative of possible intentions for higher ground for cable. Should the actual rates of the US data today show a weakening of the demand side in the US economy, as well as of the inflationary pressures on a producer's level. So that's one element which we should keep in mind regarding the pound. For the time being, cable is now testing the S1 1.2465. You can see how it has lowered slightly below it. And actually, that would allow us to lower the S1 to 1.2460, even lower 55. Okay. So for the time being, we expect that the pair may continue correcting lower, given also that the RSI indicator is still above the reading of 50, which may fuel such a correction. So that's not the issue here. However, the question is whether there will be renewed bullish tendencies for the pair in the American sessions opening today. Should that be the case, I wouldn't be surprised to see it breaking or at least aiming for the 1.2645. Actually, at this point, I will be recalibrating on the technical level cable somewhat. And there are a number of issues here. We're starting with the S1. In my opinion, that could go as high as here and serve as a resistance line. That's a level which we should keep an eye out, and that's a nice round figure at 1.25 in red. Okay, definitely we have three resistance levels here. Let's have a look at the support lines. This one could go a little bit higher, the S1, as we have here a nice peak, which is practically supporting the idea of a higher support line, and that would be the 1.2325. We can lower the support line, the second support line, and place it at 1.2090. Could go even lower. $20.60. And let's zoom out, go hunting for a new ultimate support line. Moving lower and lower. Here you go. $1.1820 in green. Okay, definitely the support lines are quite wider than the resistance lines. Now, what's the prospect for further bullish movement? On a technical level, I would be noting two factors here. Once again, the RSI indicator, which is above the reading of 70, implying still a rather strong market, bullish market sentiment. On the other hand, though, I would be noting that the RSI indicator also implies that the pair is still at overbought levels, and further correction lower seems to be along the way. The price action had broken the Bollinger Bands, yet has now broken the upper Bollinger Band, yet has now moved lower. So that seems to be providing some rooms for the bulls to re-enter the game and may allow the price action to break above the 1.25 resistance line, which was tested beautifully in the past 24 hours, actually in the Asian session. Should the pair stabilize, as it seems to be doing right now, and remain near the 1.25 but below it, that would allow us to switch our bullish outlook in favor of a bias for a sideways motion, a continuance at least. 1.1820 is the last one. Done. Now for bearish outlook, that would be rather improbable, but it's still a possibility, and it should be covered. We would require for bearish outlook cable to drop below the S1 1.2325 and start aiming for the S2 1.2060. Okay, let's have a look at USD and JPY. Okay, USD JPY, which moved decisively lower, yet some recalibration here is in place. In red. The S1 seems to be holding. That's valid. It's actually a beautiful landing here at 150.30. And we can lower a little bit the S2 at 140.80. Let's go hunting for a new ultimate support line. Zooming out a little bit. Here we have a low point here. That would be the 147.35 in green. Definitely we're going to be recalibrating the resistance lines here. Especially the R2 and the R3. Let's have a second look here. On a daily basis, as we have to go way back to 1998 or even further back to find any levels. Actually, the fact that we have to go so far back sets into question the validity of any resistance lines we're going to be finding. Given that over 30 years have passed, actually we're already at 92. Okay guys, here we go. We have one level, we're going to be raising it here. The final resistance line somewhere here. Zooming in, touch a little bit lower as well. Let's lock this in at 155.80. And the second resistance line at 153.80. We're talking about 200 pips lower. Okay. Readjusting the chart. Let's place some labels here. Zooming out. R3 being placed at 155.80 in red. Now, definitely the retreat of USD JPY. Okay, let's drill back to the 4-hour chart. Sorry about that. That's better. No, definitely the retreat of USD JPY eases somewhat the pressure on BOJ and Japan's government to actually intervene in the markets. However, I would be noting here that we had a wide contraction of the GDP rate. It was the revised GDP rate for Q3, which was definitely bad news for Japan. It intensifies our worries for the economic outlook of Japan. And I think the release will be solidifying the bank's, BOJ's, that is, dovishness, as practically the economy now is screaming for some support here. It's quite interesting what will be happening on that, on a macro level. Sorry, that should be R1. Okay, locking also in the S1 at 151.30, 150.30. Green. $148.80, the S2. And the S3 at 147.35. So for the time being, we tend to maintain a bias for the sideways motion of USD JPY to continue, possibly between the R1 and the S1 150.30. Yet a small word of warning here. The RSI indicator remains dangerously low. It's near the reading of 30, implying a rather bearish sentiment on behalf of the market for the pair. At the same time, we're highlighting that we are expecting the US CPI rates and retail sales growth rates for October to slow down or even to contract, which may weaken the USD side of the pair even further. And that would allow practically USD JPY to break the S1 150.30 and aim, if not reach, the S2 148.80. So it's a big question here how the market will be reacting. However, I wouldn't be surprised to see some bearish tendencies on behalf of the pair. On the flip side, though, I would be noting also that the price action is once again testing the low Bollinger Band, which may be slowing down the bull somewhat here. Okay, let's have a look at another pair. That should be the last one, and that would be AUD-USD. I'm highlighting this pair on a number of reasons. First of all, allow me to make the corrections regarding support and resistance lines. We'll talk the direction, and then we'll discuss also the fundamentals behind it. Let's unlock the chart, move it backwards. There you go. Zooming a little bit because I cannot see it clearly. Yep, on the shadow of a peak. And red. And that should be the 0.6740. 0.6735 it is. Could go even a little bit lower. 30. Even lower. 25. That's it. I'm keeping it because despite breaking the shadow here, it validates also the support line here. So practically, we have a 2-week confirmation of this level. Okay, locked it in. Let's start with placing resistance support lines, starting with the R3 at 0.6725 in red, please. It is. Second, the resistance line being placed at 0.6650. Let's confirm that. Sorry, that should be 0.6605. Now, the first resistance line, which is now being put to the test by the pair, would be the R1 0.6515. First support line at 0.64. Yet for the time being, support is not our main words here. In green. And placing the S3. Give me a sec. S3 at 0.6205. Let me verify that level. Yep. There we have it. On technical basis, we tend to maintain a bullish outlook for the pair as long as the price actions RSI indicator below a 4 chart that is above the reading of 70, implying that there is still some bullish sentiment present in the market for the pair. And such a bullish outlook may allow AUD/USD to break above the R1 0.6515, a level which is providing right now resistance but had done so in the past as well. So that's pretty valid. Next possible target for the bulls would be set at 0.6605. On the other hand, we may see that there may be some fatigue on behalf of the bulls. And definitely the fact that there is indicators above the reading of 17 is implying some bullish sentiment on behalf of the market. It's also the warning that the pair may be at overbought levels and may be ripe for a correction lower. So such a scenario would imply that the pair stabilizes around or just below the 0.6515. On the other hand, note that the price action, despite having broken or breached, if you prefer, the upper Bollinger Band, has now moved below it, or if you prefer, the Bollinger Band has moved above it, and that allows for a little bit of room for the bulls to continue their advance higher. For the time being, in my opinion, that seems to be tilting towards the upside, and I wouldn't be surprised to see it aiming for the R2 0.6605. On a fundamental level, I would be highlighting two issues. A, that would be on a purely fundamental level, the meeting between Biden and China's leader Xi Jinping. And should we see some thawing of the tensions in the US-China relationships, especially on military and economic level, that could provide some support for those. The second element, which I would be highlighting, would be Australia's employment data that you are during tomorrow's Asian session. And should they show that the Australian employment market remains tight, that could provide additional support for the AUSSIE. So be on your watch. That should sum it up. From all of us here at IronFX, best wishes for solid trading.
Everyone, my name is Emily and welcome to another educational video. The word Goldilocks is a reference to the popular children's story Goldilocks and the Three Bears. The term is used in finance to describe an economy that is just right with steady growth and normal inflation. It is an ideal economy that is not too hot and not too cold. In other words, it is a Goldilocks economy. In this balanced and healthy economic system, there is full employment, economic stability, and steady growth. The economy is not expanding too much to push inflation too high, and not slowing down to enter into recession. A Goldilocks economy is also good for investing and trading. In a growing economy, companies also grow and generate positive earnings, resulting in their shares performing well. Goldilocks economies are temporary in nature because there are boom and bust cycles. While there may be disagreement among economists about what the exact characteristics of a Goldilocks economy are, the basic idea is that there is a balance between growth, employment, and inflation. The ideal conditions for a Goldilocks economy are low unemployment. Unemployment is measured with the unemployment rate, which reflects the number of people willing and able to work but unable to find gainful employment and who have sought work in the past 4 weeks. The Federal Reserve estimates a normal rate to fall between 5% and 6.7%. Another condition for a Goldilocks economy is asset price inflation, which refers to an increase in prices of shares, real estate, derivatives, bonds, and other assets. Low market interest rates and low inflation are also important, as well as a steady gross domestic product. The GDP is the most essential indicator for a Goldilocks economy, as it measures the value of all services and goods produced in a country and reflects the health of an economy. For example, a negative GDP in 2 consecutive quarters indicates a recession. On the other hand, a sharp increase in GDP can push prices too high and result in high inflation. An example of the Goldilocks economy is the US economy of the middle to the late 90s, but also the US economy after the bursting of the dot-com bubble between 2004 and 2005. Thank you so much for joining us today, guys. See you soon. Bye-bye.
Okay, thanks for waiting, everyone. Let's go ahead and get started. So, first things first, a risk warning as per usual. Our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. Okay, so I'm Melanie and I will be your speaker for today. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019, 2020, and 2021. Okay, so here's our agenda for today. So we're just going to get right into chart patterns, looking at the top 3 reversal chart patterns and the top 3 continuation chart patterns. And then we're going to look at how we can incorporate them into a strategy. If we have time after that, which we probably should have, we'll then do a recap of Fibonacci and market structure, because then that leads us into other types of patterns, such as your harmonic patterns and your Elliott wave patterns as well. So we're just going to add a bit of bonus for this webinar as well. So if you have any questions throughout the webinar, feel free to let me know in the chat. And yeah, let's go ahead and get right into it. Okay, so what exactly are chart patterns? So chart patterns are visual representations of historic movements in financial markets. So in your stocks, currencies, so like your forex, commodities, so on and so forth. And these patterns are used by traders and analysts to make predictions about future price movements. So the patterns are the distinct formations that's formed by the movements of security prices on a chart, and they serve as the foundation of technical analysis. So a pattern is defined by a line that connects common price points such as closing prices, highs or lows over a specific time period. So technical analysis and chartists look for patterns in order to forecast the future direction of a security's price. So these patterns can range from the simple to complex, such as double head and shoulders formations. So let's now look at the top 3 reversal chart patterns. So these chart patterns basically indicate that there will be a reversal in trend. And of course, you would know that there are a lot of different ways for you to identify a trend reversal. But these chart patterns are our top 3 ways. Of course, you should use these not on their own, but also in combination with other technical analysis methods. So like your indicators, your moving averages, MACD, so on and so forth, or even your support and resistance levels, Fibonacci. Yeah, so if you manage to get a confluence area, which means there are multiple indicators that tell you that a trend is reversing, that's a bonus, and it's more likely that what you expect would likely to happen. So firstly, we have a double top. So a double top is a chart pattern where the price reaches a high twice, as you can see from the image that I've shown here. So we have one top and two tops, and it fails to break out higher during the second attempt. So you can see that it reverses off of that same swing high resistance. So the pattern comprises of two peaks of nearly the same size and a bottom between them. So the bottom would just be this valley area over here. And then the neckline is where we measure that support level from the bottom of that valley, I mean. So the line running through the tops is the resistance line, which should be nearly horizontal. And the pattern forms an M shape and is considered a bearish reversal chart pattern. So the pullback between the two highs should be moderate. So the pullback is just over here. And the new minor support level is then called the neckline or the support level. And then the pattern is confirmed once the price breaches the low of the pullback between the two highs. So basically, once it breaks out of this neckline area or the swing low support over here. Okay, so I've also included a candlestick formation of what I'm talking about here. So you can see based off of the chart, we have two swing highs that are about the same, or rather it's about horizontal. And then we have the valley that I was talking about earlier, which forms our neckline. And then eventually when it breaks out of that neckline, which means just over here, this area here, then that's our double top formation, or rather double top confirmation. Okay. Next, let's take a look at double bottom. So a double bottom is a chart where the price holds a low 2 times and fails to break lower during the second attempt and instead continues higher. So yes, you can kind of say that this is the opposite of a double top. So the pattern is characterized by a distinct drop in price, followed by a slight reversal or bounce, with a second drop occurring soon after to either the same or similar level as the first before another. Significant reversal so that the chart appears to take on the form of the letter W. So kind of opposite of double top, we have the neckline, instead of being on the bottom, it's on the top. And then instead of having two tops, we have two bottoms. The double bottom confirmation, similarly to double top, happens once price surpasses the neckline. Okay, so the double bottom reflects very strong levels of support, as you can see here. Okay, strong levels of support often indicates a strong change of trend. So that's why you can see once we see price breaking out of here, we can then assume that price has reversed and we're expecting price to continue upwards instead of continue to hit this strong support level here. So double bottoms appear in a downtrend and reverse it to the upside as price breaks through the resistance line. So in this case, our resistance line is the neckline here. So once again, I've included a candlestick example for you to take a look at. Our double bottom has these two, I was gonna say heads, but in this case, I guess they are kind of swing lows in this case. So our swing lows also form a almost horizontal or horizontal level, and that's kind of what you're looking for over here. It's okay if it exceeds by a little bit, as you can see from our example, but it should be approximately horizontal for you to take note of it. So you can take note of the entire length of the wick and you don't have to just measure it from the body of the candlestick. And then once price breaks out of this neckline or this resistance level, then we can say that there is a double bottom confirmation. Okay, so far pretty straightforward patterns. Next, let's take a look at heads and shoulders. So this is also pretty common. And the head and shoulders is a chart pattern that's described by three peaks. The outside two are close in height and the middle is the highest. So it's a bearish reversal chart pattern. And this begins with an uptrend with two higher highs. So you can see from the example here, I have the higher highs here would be number 1 and number 3, and the two higher lows. So the two higher lows here will be 2 and 4. And these form the left shoulder and the head. So the left shoulder is here, the head is here. 0.5 over here makes a lower high, which is lower than points 3 and 1, and this forms the right shoulder. Okay, and the downward confirmation occurs when price breaks out of this point number 6 here. So we have higher lows, from 2 and 4, and that's where we can draw our line across. Once price breaks out of here, then we can say that there is a confirmation that there is bearish reversal happening here. Similarly, I've included a candlestick example here. So same thing, we have, if you implement this diagram onto our real life example on our candlestick chart, point 1 would be here, point 3 here, and point 5 here. So if I were to draw or to measure out a horizontal line, well, it doesn't have to be horizontal, just a line that extends out of connecting these two swing lows, okay? So if I extend it out, once price breaks out of that line, then we have confirmation that price is going to continue lower. Pretty straightforward. Let me know if you guys have any questions, of course, but yeah, pretty straightforward so far. Next, let's take a look at the top 3 continuation chart patterns. So the previous 3 we looked at were for reversal purposes. Now we're going to see how we know if price is going to continue in its direction. So firstly, we have falling wedge. So all these chart patterns I'm going through now are pretty popular and quite easy to spot on your charts. Later on, when I go through some harmonics and Elliott wave patterns, those are a little bit harder to spot. But yeah, we'll go through those shapes and patterns later on. Okay, so next, let's go into falling wedge. So this is the pattern that I've included here. This is the pattern for you to take note of when you are spotting a falling wedge. So the entry, excuse me, we go for a target that's at least the size of the chart pattern for wedges and rectangles. So in the next slide, we have a rectangle as well. So we go for the target that is at least the size of it. So what we mean by that is, if you take a look at the real life example here, okay, it might be a little bit different from this diagram that I have here. But basically what happens is you have this price moving upwards, and then you have price making lower highs. Okay, so it's making lower highs, whereas our bottom line, or rather the swing lows, if you connect the swing lows, it gives you an approximately horizontal level. Similarly to before, doesn't have to be horizontal, just approximately horizontal is fine. So that would be our stop loss. Okay, once we have this level that we have connected all of the swing highs, that is our entry level. And then we're going in for our take profit or target level would just be slightly above that. So because we're expecting price to break out of this shape, this higher resistance level here. So the upper red line, that's our resistance level, and we are expecting price to break out of it. Because there's a lot of downward pressure that's pushing on this area or this shape, so we're expecting price to break out, and that's why our take profit would be a little bit higher up. So that's why I've arranged the levels in this way for you guys to see. Okay, I hope I explained that properly, but let me know if you guys have any questions. Basically, if you draw out the shapes here, it would connect these 3 swing highs. If we ignore this area here, because we're expecting price to break out and hit our take profit there. So in the meantime, we'll just look at these 3 swing highs, connect these levels, and then on our bottom, we have our stop loss, and the stop loss is achieved by connecting the swing lows instead. So we connect the swing lows, that's our stop loss, and then we proceed with our entry. So we go in with our buy entry from this level, and then we see it shoot up to our take profit here. Okay. Okay, if we have time after the slides, we'll definitely take a look at some setups, and I'll definitely take a look at gold. But because this webinar is for chart patterns, So we'll take a look at our slides first. If we have time, then I will take a look at gold. Okay. So our next continuation pattern that we want to talk about is bullish rectangle. Similarly for bearish as well, it's about the same, just opposite areas, or rather opposite direction. So in this case, our bullish rectangle, we have 3 swing highs, so it doesn't have to be 3. You can see in our example with the candlesticks, it's just a consolidated area in which price is testing the upper boundary and the lower boundary, or resistance and support level. So if you connect this area here, it's pretty easy to spot. It's just about the same length of candlesticks and wicks. So our entry would be the upper boundary, and our stop loss would be the lower boundary. And then we're expecting price to break out of this consolidated area, break out of it, and hit our take profit. Okay, so that's for a bullish rectangle. If we're talking about a bearish rectangle, for example, we can expect our diagram to be the opposite. So instead of price moving upwards, we expect price to move downwards. Same thing though, our entry level instead would be our stop loss, and our stop loss instead would be our entry, or rather our sell entry. And then once we're expecting price to break out of the consolidated area downwards towards our take profit, which would be, of course, lower than our entry level. Okay, so obviously for bullish rectangle, we're going in for a buy. And for our bearish rectangle, we'll be going in for a sell entry. Okay. Next, let's take a look at bullish pennants. So for bullish pennants, some people call this flag shape as well. So yeah, it's entirely up to you what you want to call it, but it's all about the same. So for a bullish flag, we have this shape here. Once again, from all of these shapes, we are basically connecting the swing highs with the other swing highs to form a line, and then we see where those lines connect. Oop, sorry about that. So we connect the lines here, and then we connect the bottom lines as well, and then it should give you this flag kind of shape. Okay, so if we're talking about a bullish flag, price will be moving upwards, and then we will expect price. So price is testing within this consolidated triangle area. So we're expecting price to break out of this area and continue in the upward movement. That's why we call it a continuation chart pattern. So price trend is upwards, price is consolidating in this area, and then if we draw out the connect the areas, connect the tops and the bottoms, then we have this flag shape, and then the next step would be to measure out your take profit. Okay, so your take profit would be, as we mentioned earlier, either the size of the same size of your shape, or bigger. So as you can see here, our shape is, yeah, you can see the size of our shape here. So our take profit would be times 2 of that. So we would measure our take profit over here. Or rather, we would put our take profit over here. Okay, so for a bearish pennant, on the other hand, same thing, just the opposite. Price will be moving downwards. Okay, instead of our buy entry being over here, we will replace it with our stop loss. And then stop loss, we will replace it with our sell entry. Price will once again consolidate within this area, okay, or within this triangle. Once it's consolidated, we will place our take profit times 2 below that. Okay, and then it'll break out of it and then hit our take profit, hopefully. Okay, but that's just how you use this bearish pennant or bearish flag shape. Okay, so that's actually kind of it for the top 3 chart patterns for continuation and reversal. but I wanted to talk a bit about harmonics and Elliott waves as well. Just briefly touch on it if you missed our previous week's webinars. Okay, because when we're talking about chart patterns, even trend lines, support and resistance, all of that are considered chart patterns as well. So yeah, let's just talk a bit about Elliott wave and harmonics. So before I do that, in order to really understand the harmonics and Elliott wave patterns that we're going to be getting into, I'm just going to do a really quick recap on our Fibonacci, because without Fibonacci, the Elliott wave and harmonic patterns really don't quite make sense. Okay, so we have the different Fibonacci levels here, and if you've been with us for our previous Fibonacci series, we go through in depth the Fibonacci retracement, expansion and extension, as well as projection levels. But for now, I'm just going to briefly go through the retracement levels. So for the negative Fibonacci levels, minus 27.2 and minus 61.8, those are our Fibonacci expansion levels. And then the between 0 to 100 levels, those are considered Fibonacci retracement. And then for the 127.2 and 161.8, or above 100%, those are what we call our Fibonacci extensions. Okay, this GIF here, you can see we are following exactly the pattern, or rather the structure of the market, and that's quite important. So here we show you exactly how to draw your Fibonacci. So for retracement, as you can see from the previous slide, the GIF just follows exactly the shape of the chart. Pretty straightforward. My projection is not showing, I'm not sure why, but I'll show you guys that in a second. Next, if we look at expansions, we're looking for a flash kind of shape. You can see now in this GIF, I'm drawing out exactly this flash shape. Flash or lightning bolt shape, whichever you prefer. So our starting point and ending point for expansions lines up nicely with the head of the lightning bolt. And then for expansions, as I mentioned earlier, we are looking at the negatives. So minus 27 and minus 61.8, if I'm not wrong. So yeah, so we take notes of those levels, and for 0.3, it has to retrace at least 50% of your starting and ending points. If we look at our extensions, you can see we've drawn out this Nike tick kind of shape. And that's exactly what we call Fibonacci extensions, the Nike tick formation, because that's what you're looking for. In this case, we have an upright Nike tick, but in the next couple of slides, I'll show you guys examples of inverted Nike ticks and how you can use those as well. For extensions, we are using more than 100% levels, so the 127 and 161.8. Okay, here you can see all the different Fibonacci numbers that we mentioned in our previous slide and how it looks drawn out. So yeah, I think you guys can see for yourselves. Positive Fibonacci retracements are our expansions. Fibonacci retracements are 0 to 100%. Negative Fibonacci levels are what we call our expansions. So more than 100% extensions, less than 0% or negative would be expansion. Okay, so here's an example. I have my Fibonacci retracement. So remember, I mentioned how important it is for us to follow the market structure. So that's exactly what I did here. My starting point here, ending point here, and I'm looking at where price has retraced this level. So this 23.6, 38.2, 50%, these are no longer valid because price has already passed these levels. Okay, instead, I'm taking note of the 61.8 because price has reversed or retraced this level and has reversed off of it. Okay. Okay, here is another example of Fibonacci retracement. Okay, in this case, I'm doing it upside down here. So, oh, am I? No, okay, this is not upside down, sorry. So my starting point here, ending point here. Now I'm seeing once again where my price has retraced to, and I can see my price retraced to the 38.2 level. So I highlighted this level because this dotted line at 32544, it is at this this retracement level, but you can see that price also pulls back all the way to this level here, this swing high. So this is what we call an overlap support. So an overlap support is basically when a swing high lines up with a swing low, and it's important because we can see that price, the bulls as well as the bears both respect this area. So that's why it's important, and that's why I've highlighted it here. Okay, so having an overlap support also line up nicely with a Fibonacci level. That's what we call a confluence area. And so we can probably expect price to reverse off of the area as we can see here. So if you have this and then you couple that with your indicators as well as some of the chart patterns that we've mentioned earlier, then you can see there's a higher chance that your analysis will be correct. Okay, so in this example, we have two Fibonacci retracements. So notice how the big Fibonacci retracement trend line price reverses off the 61.8% Fibonacci retracement level. Okay, so my Fibonacci retracement that I was talking about is here. We have the bigger one and the smaller one here. Okay, so both 61.8, but for the bigger one, my 61.8 lines up with the swing high. Okay, and then my smaller Fibonacci retracement, 61.8 as well, lines up with two swing lows. So this once again is an important level because we see that price has respected this level twice. So it's likely to respect this area again in the future. Okay. Okay, next we're going to get into Fibonacci expansions. So an example of expansion and how it plays out, as I mentioned earlier, expansions, we are looking for a flash shape. So this flash symbol also is applicable for Fibonacci projections. So our starting point is here, ending point here for expansions, and we're taking note of the negatives over here. So firstly, my first point, starting point there, ending point there. Number 3, if you can see here, price retraces up to the 61.8% level. So that is our Fibonacci retracement since it's between 0 to 100%. Yeah, so levels, it respects this 61.8, reverses off of it, and it's heading downwards. And in order for us to project where price is heading towards, that's where our negatives come in. We're expecting price to come down to this negative 27.2, where it could bounce off from support. Okay, and you can see this is the aftermath of that, and that's exactly what happened. Price bounced off and reversed off of our negative 27.2. Okay, bounced off really nicely. And a pro tip is that price usually comes back to this ending point over here. Okay, why does it usually come back? Because as I mentioned earlier, when we have if I were to extend this level, you can see price has tested this level before as well. So we already have two swing lows that line up on the same support level. Now that price has broken out of it, we can expect price to pull back to that level. Okay? Next, we're gonna get into Fibonacci extensions. So we are moving a little bit fast because I want to get into the chart patterns for the harmonics and Elliott wave patterns, since this webinar focuses on chart patterns. So I want to quickly get through the Fibonacci recap so that we can get into the patterns. But if you're confused, let me know in the chat. Yeah, but normally we go into depth in depth um each of these Fibonacci techniques in our Fibonacci series. So you can stay tuned for those, or you can go onto YouTube and take a look at those as well. Okay, so next we're talking about Fibonacci extensions. So as I mentioned earlier, Fibonacci extensions, we're looking for Nike ticks. Okay, so our starting point is the head, starting and ending point is the head of the tick. And then once price, we're looking at this V shape. Okay, so we're looking for V shape, and the tail of the tick should exceed 100% of the head. Basically, it should be longer than the head. That's what makes a tick, right? So the projected level is either the 127 or 161.8. In this case, price has already broken out of the 127, so we are expecting price to hit towards our projected level of 161.8. And you can see that's exactly what happened here, and a reversal occurred, reversed off of this level and headed back downwards. So it's another indication of a reversal. Once again, you use this in combination with your chart patterns, like the top 3 chart patterns I went through previously, your indicators, and you're good to go. Okay, here is a GIF to show you guys exactly what kind of shape you should be looking for when you are making use of Fibonacci extensions. Okay, so we're looking for reactions off of the 127.2 and 161.8. Once price breaks out of the 127, then you can go ahead and assume that price is going to reverse off of the 161.8. Okay? Yeah, I just let you guys watch the GIF a couple of times and then we can move on. Okay, so we're watching the reaction of the 161.8. Okay, let's move on. So next we have the Fibonacci projection. And excuse me. So we have the Fibonacci projection, and this tool on MT4 is actually the Fibonacci extension tool. Okay, so ultimately, unlike the other 3 methods that we've gone through so far, this method actually requires 3 points. So we need the starting, the middle, and the ending point. Okay, so for this technique, we use namely 3 percentages: 61.8, 78.6, and 100%. But if you're using Elliott wave, we also make use of the 161.8. Okay, for Fibonacci projection, similarly to Fibonacci expansion, we are also looking for the flash zigzag kind of shape or lightning bolt shape, as you can see from this GIF here. Okay, so our starting point here, middle point here, ending point here, we're projecting where price will react off of. And we can see price has already broken out of the 61.8, 78.6, and that's why we can assume that price will reverse off of the 100%. Okay, let's just watch the GIF. Okay, so not included here is the 61.8, 78.6, but we're watching it play off of the 100%. Okay, and you can see it reached 100% before reversing off of it. Okay, but something I wanted to mention is that you can see that the wick of the candlestick was it like just nice touched our 100% level, which is why it's important that you take note of your trade management strategies as well. You want to make sure that you remember not to put your take profit exactly at your Fibonacci levels or exactly at your confluence areas when you're using indicators, so on and so forth. And that's because price might be it's attracted to these levels, but it's also likely to reverse off of them because of the huge confluence area. So something that we recommend normally is to place your take profit before the level or before a confluence area, basically before where you expect price to hit. And then for your stop loss, you want to make sure that you place it beyond it. So in this case, we would place our take profit higher up, above our 100%, just in case price misses it by a little bit. At least we would have caught that this reversal. Okay. Okay, let's move on. So here's another example. I'm not sure why all of my titles are covered, but here's an example of the Fibonacci projections. So you can see clearly the starting, middle, and ending points here. And these follow the swing highs and the swing lows of price. So it's important for your Fibonacci trend line to follow price movement or market structure really closely. So price has also bounced off of the 100% Fibonacci level over here. So you can see this is our shape, our flash shape, and we're expecting price to go down towards our 100%. You can see it reversed off nicely. Okay, another example. We have a very obvious zigzag or lightning bolt shape over here. So you want to take note of the Fibonacci trend line following the market structure closely. And also we have the 78.6% Fibonacci extension. So because our expansion and our projection use the same shape, more often than not, you can use both together and find confluence areas. Okay, so you can see price really bounced off of our 78.6. One more example for you guys. Starting point, middle point, ending point. You can see the shape here. 100%, we're expecting price to hit it. And you can see it reverse off of it nicely. So an invalid Fibonacci retracement occurs when price makes a lower low. Okay, so if there are bars on the right that break your ending point, it becomes invalid. So I'll show you guys what I mean. So this is what we mean. Bars on the right that break out of this lowest point. So because this is no longer the lowest point, it cannot be your ending point. Okay, so we always want to remember to pick the lowest point with nothing on the right of your ending point. So just, this is a bad example to use for a Fibonacci retracement, basically, because price has already broken out of it. Okay? Yeah. So as I mentioned earlier, market structure is really important. You want to make sure that your swing highs and lows are significant levels so that they're good points to use for Fibonacci. And yeah, this is the kind of structure that you want to look for when you are looking for Fibonacci levels, or even when you are doing your analysis, your technical analysis. Okay, I'm just gonna skip through those and get right into pattern identification. Okay, so we mentioned earlier a couple of M's and W's, but we have a couple more patterns just briefly to go through with you guys. So for these lean more towards the harmonics patterns because they're more complex and a little bit more technical to understand compared to the top three patterns that we went through earlier for continuation or for reversal. So you can see instead of our simple M, we also have extended M's, short formed M's, instead of the simple W, as we mentioned earlier, which would be our reversal patterns. We now have extended W's and short form W's as well. So they're just slightly more complex to understand, but once you do, they can be spotted really easily as well. So all primary harmonic patterns are 5-point patterns with points X, A, B, C, and D. So similar to what we talked about earlier, we have points 1, 2, 3, 4, 5, and 6. Here we have X, A, B, C, and D. So price swings between these points are interrelated and have harmonic ratios based on Fibonacci, which is why we went through Fibonacci really quickly earlier on. So this is because Fibonacci ratios help traders in defining precise turning points in these patterns. So it tells you exactly where you can expect these swing highs or swing lows or the neckline points that we mentioned earlier that can be used as your entry and exit points. Okay. So we went through a couple of M and W's earlier, so I'm just gonna move on to show you guys how to identify some patterns. So here are some variations of our M and W points. The breakout points, as we mentioned earlier, happen once price has broken out of the neckline area. So even though it's slightly different, uses a little bit more Fibonacci tools, but ultimately the theory behind it is about the same, or how you use it is about the same. So breakout or upside confirmation basically occurs when price breaks out of this neckline area. If we're talking about a M top, breakout or downward confirmation happens when price breaks out of this neckline. So pretty similar to what we talked about earlier. Okay, so let's talk a little bit about harmonic patterns. So all 5-point harmonic patterns have similar principles and structures, and they differ only by the ratios that are used to identify them and locate their keynotes. So in this case, we have X, A, B, C, and D, as I mentioned earlier. So I've included the Fibonacci levels as well, just for your reference. So from point A to C, it uses 38.2 to 88.6. X and B, 61.8, X and D, 78.6, and B to D uses more than 100% levels. But that's just for your reference. 5-point harmonic patterns have a critical origin at X, followed by an impulse wave, which is XA. So just the blue line here. So these are followed by a corrective pattern wave to form the EYE of the pattern. So this is at B, okay, completing the AB leg. Then followed by a trend wave at BC, which is another blue line here. Then ignore this line, and finally completed at the corrective leg, CD, and we call this the potential reversal zone. Okay, we call it that because we're expecting price to break out of this neckline area in order to give us downside confirmation. So it's, even though it looks a little bit more complicated, it's basically about the same as we talked about earlier. Okay, here is how we use Fibonacci in this case. Possible pattern formation is identified after the first three legs. So XA, AB, and BC. Then we see where exactly we can place our entry level. Normally, your entry level would come after this neckline area here, because that's where you get downside confirmation. Okay, the Fibonacci ratio extensions, retracements, and projections are then used to determine the potential reversal zones. All harmonic patterns have a clearly predefined potential reversal zone, and the initiation of new trades should take place in this zone, so over here, and only after price reversal action. So after price breaks out of this B, this B level here. Okay, so a couple of patterns for you to take note of. We have the Gartley pattern. So this is the best known harmonic pattern. So after the wave, impulse wave at XA, the corrective wave, or the corrective leg, sorry, should end at 61.8. Okay, 61.8 retracement of XA. Point C falls anywhere between the 38.2 or 88.6 retracement of the corrective leg of AB, including all harmonic trading ratios that fall between these two constraints. So it can be 50, 61.8, 70.7, 70.6, basically any level, Fibonacci level that's between these two numbers. Okay? And yeah, long positions should be considered after a clear bullish reversal with a stop loss placed below the potential reversal zone. So if we're looking at bullish, your potential reversal zone would happen obviously after this this neckline level here. So your potential reversal zone would happen somewhere here. If we're looking at a sell, it would happen after it breaks past the B level. So anywhere after that. Okay. Next, let's take a look at bat pattern. So this is considered the most accurate pattern. And you can see once again it's pretty similar to your W and M patterns. Okay, just with a couple more Fibonacci levels to take note of. So some main rules of the pattern: AB leg can retrace between 38.2 to 50% of the XA leg. The BC leg can retrace between 38.2 to 88.6% of the AB leg. And the CD leg can retrace up to 88.6% of the XA leg. CD leg, so the last leg, can also be an extension of between 161.8 to 261.8 of the AB leg. Okay, it doesn't make sense now that you are just looking at the shape. It just looks like a bunch of numbers, but when you actually try using Fibonacci levels to distinguish the different patterns, it would make more sense then. Okay, and then for the bullish, of course, it's just the opposite of your bearish. So here's an example of a cipher pattern. So cipher pattern uses 38.2% to 61.8 for XB, 127.2 to 141.4. This is for your AC, and for XD, 78.6. And bearish is the opposite of that. Okay, so here is what a cipher pattern looks like on the chart. So you can see it's a little bit more difficult to identify because you would need to take note of the numbers, but ultimately it's still the theory behind it is still the same. Because after it breaks out of this cipher pattern, then we are expecting it to move upwards after it breaks out of this B shape here, or rather this neckline. Once it breaks out of it, that's our potential reversal zone, right? Then it's going upwards, and we can place our take profit, as we mentioned earlier, 2 times the size of your B. So from here to here, this is your potential reversal zone. So times 2 of that will be here. Okay, remember we want to place our take profit before any important levels, so we probably place it somewhere lower just to be safe. just to make sure that we catch that before the reversal occurs. Okay, butterfly patterns. So butterfly pattern requires a retracement of the impulse leg XA by 78.6. Okay, you can take a look here. So I'm just going through the different types of patterns, but there are a lot of different types of patterns. You could probably Google it. But yeah, I'm just going through the different kinds of chart patterns that you can see. Okay, but I think the most important ones are the ones that I talked about at the start. These are just more for your knowledge. Okay, so point C retraces anywhere between 38.2 to 88.6, as you can see here, of the corrective leg AB. Okay, bullish would just be the opposite of that. Crab patterns. So the crab pattern was discussed and released in 2001. So this is an extreme pattern, and the corrective wave AB should end between 38.2 and 61.8 retracement for the impulse leg of XA. Okay, long positions should be considered after a clear bullish reversal with a stop loss placed below the potential reversal zone. So stop loss would probably be somewhere here. Okay, remember the potential reversal zone is basically the area after the neckline area. Okay, bullish sharp pattern. After the impulse wave XA, the corrective leg should end between 38.2 and 61.8% retracement of the impulse leg XA here. Okay. So you can see the arrows. Once price breaks out of this level here, then we're expecting it to reverse. Similarly over here, we're expecting it to reverse. Okay, just some advantages and disadvantages for you to take note of. So they are repeatable, reliable, and do produce high probable setups. And they provide future price projections and stop loss levels as well. And they can be considered as leading indicators. Their trading rules are relatively standardized since we're using Fibonacci ratios. So, and they work on all time frames as well. Okay, some disadvantages are that they are quite complex and technical to understand and master. But like I mentioned earlier, as long as you have the basics or you kind of know what you're looking for, once you master the art of Fibonacci, then you've kind of got it under your belt. Okay. And yeah, that's all I have for you guys today. Thank you guys so much for joining me. I hope you guys found it helpful. And yeah, I will see you guys next week. Thank you guys so much for coming. Have a great rest of your week. Bye, everyone. Thanks, guys. Bye.